In today's video, we will be looking at what is a stock, the two different types of stocks, and how to buy a share, all the while hopefully keeping it plain and simple. I don't believe in milking a video, so here it is. What is a stock? It's a security that represents ownership in a company. Traditionally, stocks are called shares when spoken in a unit format. They confer assets and profits equal to how much of the stock you own. That's it in a nutshell. Now, if this is the first time you have heard about stocks, you might be sitting there wondering, okay, what does any of this mean? Here is the Boring Joe breakdown, without the financial technobabble attached to it. A stock is owning part of a company. Shares are how much ownership you have or how many parts you have of a company. And by owning shares, you gain the benefits of a company that is doing well financially, be that through organic growth or the payment of dividends as time goes on. An example of this would be Boring Joe Inc. No, it's not a real company yet, so just bear with me. All of the shares in the world of Boring Joe Inc. equal the totality of the company. You benefit when Boring Joe Inc. does well, because people will want to own the shares that you own and any of the dividends that they might pay out. Another example is in order, though. If you have 10 shares of Boring Joe Inc. bought at $100 per share a month ago, if you sell them today at a price of $120 per share, because the company posted record profits, you will have made $200 on your initial $1,000 investment. The process described above is called capital appreciation, or as I termed it earlier, organic growth. But let's start using that term so we can get used to the financial lingo, capital appreciation. The second way to profit from a stock is via dividends. To use the same scenario as above, you have just bought $1,000 of Boring Joe Inc. at 100 shares for a grand total of 10 shares. This stock pays a 3% dividend every year. That means that you will receive $30 for just holding the stock. Unlike capital appreciation, though, dividends can be reinvested or paid out without cashing the shares, which means you will have the option of growing your position within the company or enjoying a $30 dinner every year courtesy of Boring Joe Inc. Now that was a very simplified overview of what is a stock and how you can profit from them. We could go down the rabbit hole of index funds, mutual funds, ETFs, return on equity, risk, options, so on and so forth. And we will, but for now let's just stick to the basics and talk about the two types of stocks that are out there. Common stocks is the first type of stocks that we will be talking about. They grant you the ability to vote on key matters within the company you own shares in. An example of this would be electing the board of directors or certain company-wide policies. They also allow you to benefit from capital appreciation and, if the company has chosen to, receive dividend payments. This brings us to the second type of stock, which is far less common than the common stock, because of course they are. Preferred stocks are the more complicated version of the two options out there because that is the way of finance. In a nutshell, preferred stocks are issued by companies as a pseudo bond. They have a face value or par value, a set maturity date which will be forced to either sell the share back to the company or in some cases they can be converted to common stock at an unfavorable rate. They also typically do not confer the right to vote like common stocks do. Preferred stocks do have advantages though. Primarily, they are very stable price-wise compared to common stocks because the company will buy them back at their original face value. You also are going to receive dividends ahead of common stock shareholders. This means that you're better protected in the case of a bankruptcy as you get paid out first before anybody else who holds shares would. Hence the preferred part. But wait, Boring Joe. That's all fine and dandy, but how do you actually go and buy a share? Ah yes, the bonus round. To us Joes, there really are only two ways that you can buy stocks. The first option is to open a brokerage account with a broker, something like Robinhood, Fidelity, Webull, just to name a few. The second less common option though is through an employer-sponsored 401k plan or a direct stock plan, offered by employers. Some companies offer both of these options, but like everything else in life, there's usually a fee attached to these. As a rule of thumb, though, if you can contribute to an employer-sponsored plan or a direct stock plan, it can be advantageous to you to do so. However, you should always keep in mind your personal financial goals and your financial capabilities before investing into any sort of instrument. I cannot bring up 401ks and not give my personal view on them. In the world of finances and investing, there are generally no free lunches. But if I could think of one, it would be the 401k matching contribution scheme. This is when your company matches a certain dollar amount of your investments into a 401k account. I cannot stress enough why this is so important, and it should be on everybody's radar if their company offers one. In essence, it's free money to help your account grow as fast as it can. If you can do so, investing up to your company's matching percent is a must. Your investments would grow at twice the normal rate just by using the matching contribution. Here's an example. If Boring Joe Inc. offers a 5% match and you invest 5% of your income into the plan, that means that 10% is being invested into your 401k, which means you start at 100% return because of Boring Joe Inc.'s match. Now, that doesn't take into consideration market fluctuations or the inherent risk in investing, but with all things being equal, if your 5% match equals $100 and your company matches $100, your total investment is now worth $200, or a return of investment of 100%. If you liked the video, please give it a like and a subscribe. If you have any feedback or questions, please leave a comment. Thanks for watching. See you next time.